everyone, my name is Ishika Jain and I welcome you to Brainvibe. Today in this video, we will be talking about basics of stock market. Investing in equities is an important investment because it helps us to generate inflation-beating returns. Having said that, how do we go about investing in equities? Clearly, before we dwell further into this topic, it is essential to understand the ecosystem in which equities operate. Just like the way we go to our neighborhood kirana store or supermarket to shop for our daily needs, we need to go to the stock market to shop, that is to transact in equity investments. The stock market is a place where anyone who wants to buy or sell equity investments goes to. Now, transact means to buy or sell equity shares. You cannot buy or sell shares of a public company like Infosys without transacting through the stock market because of practical purposes. The main purpose of stock market is to facilitate your transactions. Now, if you are buyer of a share, the stock market helps you to meet the seller of the share and vice versa. Now, it's very important thing that we need to understand. Suppose we want to buy share of Infosys at 1400 rupees. Now when we want to buy it, there is a seller standing over there who wants to sell Infosys at price 1400. Once he sells, then we are able to buy those shares. So in this way, the transactions are interrelated, and in this way, the price keeps on moving upwards. Now as the seller sells those shares, the shares get debited from his account and then it gets credited to the brokerage account in which you are transacting, and then later it gets credited to your Demat account. So in this way, the transaction keeps on moving. Stock markets exist in electronic form. You can access the market electronically through computers or through mobile phones. Now talking about trading in stocks. When you buy a stock, you become part owner of the company. You can buy a stock by giving a call to your broker or through the mobile app of your brokerage firm or even through online. So when you are buying a share, you need to select the quantities in which you want to trade in. And then later you can sell your share at the current market price, or you can also add limit to the stock price. So suppose I have in my mind that a particular stock will reach the price XYZ. So I don't know when it will reach, but I have this thing in my mind that whenever it will reach the XYZ price, I will sell that stock. So what I can do, I can add that price XYZ in the limit section. Okay, and whenever that price will come, my shares would be sold immediately. So this helps when we cannot keep a constant eye on the stock prices and we have a particular price in our mind, that if I earn this much, I am satisfied with that. So that is beneficial for those type of people. In a similar way, we have stop loss. So if we have purchased a share and it is going in the downward direction, and after a certain point of time we cannot bear much loss, so at that time we can add stop loss to it according to our risk appetite. And when we purchase shares, it gets credited to our Demat account after 3 days. We can see the transaction immediately in the contract note, but the shares get credited to our Demat account after 3 days because the process takes time. It gets debited from the seller's account, credited to broker's account, and then credit to our Demat account. Talking about the stock exchanges in India, there are two main stock exchanges in India: Bombay Stock Exchange, that's BSE, and National Stock Exchange, that's NSE. Now if I were to ask you a question that how is the stock market moving today? How would you answer that question? Now there are 5,000 listed companies in BSE and 1,641 listed companies in NSE. It would be really clumsy if you check on every company, then figure out that it's moving up or down and then give me a detailed answer. It would take a lot of time. So what we can do is, we can select few companies and check how are they moving. If they are moving up, we would say the market's moving up, and vice versa. So the selected few companies make up the stock market index. There are two market indices: Sensex, which represents Bombay Stock Exchange. It has 30 well-established companies in it. Second, we have Nifty, that represents National Stock Exchange. It has 50 well-established companies in it. Now the question arises, which companies are selected in the index? To include a stock in the index, the company should follow certain criteria. Once selected, the company needs to continue to fulfill that criteria. If it fails, the company gets replaced with another stock which fulfills that criteria. Now each stock has a particular weightage in the index. Weightage in simpler terms means the importance that the stock has in the index as compared to other stocks in that index. So for example, let's say ITC has a weightage of 7.6% in Nifty 50. So it would be good to say that 7.6% of Nifty's movement is attributed to ITC. The weightage is determined by the market capitalization of the company. Now the question arises, how can we get our company listed on stock exchange? There are two main ways, either direct listing or through an IPO. An IPO is initial public offer wherein the company offers share to the general public in exchange of money, of course. So the general public can subscribe to those shares at a certain price. When the price gets listed on the stock exchange, the price can be either premium or discount. Now, certain investors generally sell after the IPO gets listed at a premium price. But if you believe in the company, in the future plan of the company, you can keep that IPO turned share for the longer investment also. But there are also times when the IPO gets listed at a discount price. It can be because of the market condition at that time. The market could be bearish at that situation. So yeah, if the market is moving upwards, it's called a bull market, and if a market is moving downwards, it's called a bear market. One invests in stock market by doing either fundamental analysis or technical analysis. Now, fundamental analysis means they look at the company's plan, the future plan, the founder of the company, what are they doing at the current situation, and their financial statements. In this way, an investor decides if they want to invest in a company or not. This is called fundamental analysis. Apart from this, there are investors who invest by technical analysis. Technical analysis requires reading of charts. It requires a lot of study. Apart from the price moving up, one can also earn in stock market by dividend. A company declares its dividend when they are in profit, and then they distribute that profit among its shareholders. So yeah, that's it for this video. I tried to cover a few basic things that one needs to know before starting to invest in stock market. If you have any queries, please leave down in the comment section below. We would be very happy to reply you all. Thank you for watching this video. If you like it, please give it a big fat thumbs up and don't forget to subscribe to our channel. See you in the next video.